In December of 2015, the Federal Reserve increased the key federal funds rate. When they did that, a lot of people were worried, believing the fact that if that went up, then mortgage rates were going to go up. In fact, mortgage rates don't relate directly or even at all to the federal funds rate, which does have a bigger effect on rates such as credit cards. In order to understand how mortgage rates are calculated, we need to actually look at the secondary mortgage markets. In order to explain that, you have to understand that most banks, when they give a mortgage to somebody, they'll take that paper and sell it to one of the government-sponsored entities, Fannie Mae or Freddie Mac. Now those groups will then package the mortgages together and sell them onto the secondary markets. And it is those secondary markets that set mortgage rates. How do they do that? Well, they tend to look very closely at the 10-year Treasury bond. So they look at the bond markets, and they will always have a spread. Mortgage rates will always be higher than the yield on the 10-year Treasury. Why? Because if they weren't, no one would invest in mortgages when you could invest in bonds instead. But they relate very, very closely to each other. So to understand mortgages, you really need to look at the bond market. When do bond rates go up? When do yields increase? They tend to increase when an economy is doing better, because at that point in time, people tend to invest more in stocks than they do in bonds. Additionally, when you start seeing inflation coming into play, you tend to find rates going up at that point in time as well. And finally, when the overseas markets are doing well, that's when you tend to see those rates rise. Where do we stand today? Well, there's still a substantial amount of investment in bonds, generally because of geopolitical issues overseas. People moving money into the relative safety of the United States bond market. How do I see it going forward? I think that the yields are going to remain fairly static through the course of most of this year. Mortgage rates are going to rise, but the increase is going to be modest. I certainly don't expect the end of the year 30-year fixed rate mortgages being much above 4.2 to 4.3%. That is certainly higher than the historic lows that we saw back earlier on this year, but the trend is still such that I don't expect mortgage rates to go up by much, at least for the next couple of years.